stockpiling equipment. Our equipment is stable, and I think that's in large part because of the instructions the president gave me.
But do you have a number of how many have been tested out of the number that
We've
needs to be
tested
tested?
several hundred. I can't give you the
200
direct.
the other day.
Yeah,
Is it
we've
higher
tested
than
several
that?
hundred. Yes, we've
Do you
tested
know
several hundred. I
exactly?
don't know exactly. I do know that 44 veterans have the virus. Most of those are quarantined at home.
Can you get us the number?
Go ahead in the back, please.
Thank you, Mr. President. The question for Dr. Burks, quickly. I'm trying to understand what it's about the mortality rate. Yesterday, we underlined the fact that we had reached 100 deaths. And this morning, we wake up and we're at 110. Within 12 hours, we climbed by 10%. Is it something we have to expect from now on, a 10% increase every 12 hours?
So very early on in each one of these cases, if you look at all of the countries to date, the mortality is higher at the beginning because you're diagnosing the sickest, the ones who came in quite ill. And I just want to remind the American public that still the majority, the risk for serious illness in the majority of Americans are low. But that doesn't mean that you can't transmit it to one of those higher risk groups. And that's why we're asking for all Americans to take responsibility. You're seeing mortality or deaths today from infections that occurred 2 to 3 weeks ago in general. The other thing that you're seeing is the dramatic and very difficult impact of this virus in nursing homes. And that's why very early on, the president and vice president had us come out and CMS put those very strict rules in place. And everybody thought we were being too strict and keeping loved ones away from their family in nursing homes. If we're going to solve this with a lower death rate, we have to protect the elderly because of their percent is much higher in mortality than any other age group.
Okay. Go ahead, please.
Mr. President, there's reporting that the federal government has a plan that shows that this coronavirus outbreak might last as long as 18 months. Are you seeing those numbers? Could it
No,
just
we're not
actually
seeing
last?
that at all.
And then my second question is, there are at least one White House official who used the term Kung flu, referring to the fact that this virus started in China. Is that acceptable? Is it wrong? Are you worried that having this virus be talked about as a Chinese virus, that might help?
I wonder who said that. You know who said that?
I'm not sure the person's name, but would you condemn the fact
say
that
the term
Kung flu,
again.
A person at the White House used the term
Just the term.
Kung flu. My question is, do
Kung
you think
flu.
that's wrong, Kung flu? And do you think using the term Chinese virus, that puts Asian Americans at risk, that people might
No, not
target
at all.
them?
No, not at all. I think they probably would agree with it 100%. It comes from China. There's nothing not to agree. Okay, how about last question? Please, go ahead.
Switching gears very quickly.
Say it.
Switching gears to a larger question here. We've seen that before the pandemic, there were a lot of Americans that were already alienated. We saw deaths of despair increasing through suicide and other things. Now, as these individuals, a lot of times in rural parts of the country, are self-isolating, what is your message to those individuals, and what do you hope that individuals, communities, and churches will do to reach out to
my
them?
message is to all Americans, but to those Americans who are going through a lot, we love them, we're with them, and we will not let them down. Thank you all very much.
Mr. Vice President, do you agree with the term Chinese virus?
Are you concerned about contracting coronavirus or your employees? And two questions on the personal front about you yourself, but also about managing money at a time like this when we're hearing wild things about liquidity and how it may be lacking when the bond market is doing a lot of confounding things. How would you describe those experiences?
Yeah, I mean, there is certainly a liquidity crisis going on. People are basically trying to get cash and sell anything that they can to do that to protect themselves against a further decline. And that also is mixed in with the coronavirus, which is the cause of this liquidity scramble. And again, I think just people following the directions of the public health authorities here is the right way to go. I mean, I'm in that range of over 70, so the fatality rate is considerably higher for it would be for my grandkids who would probably skate right through this. So, I mean, I'm doing the same thing that probably most people are doing. People in our office are working from home if they would like to, or if they want to come in the office, that's fine too. We have a small team and nobody really sits that close to each other anyway.
Right.
I'm down in Florida, and so at least as bad as it is, in the markets, the weather here is very nice, and I'm just sitting in the house and watching the carnage in the market and trying to really see how we can improve our positioning in our portfolios so that when things do get better, that we're positioned to take advantage of it.
And I want to ask you about that detail, but one more kind of macro question before I do. There's a lot of talk now about these lending facilities, about as some are calling it, bailouts of the airlines and of other really hard-hit industries. Now there's talk of attaching conditions to that. Senator Warren, for example, saying if we do these quote-unquote bailouts, these companies should maintain payrolls, do a $15 minimum wage, prohibit buybacks, dividends, or executive bonuses for 3 years, turn one board seat over to workers. Does that risk doing more harm than good? And should there be any conditions, even as simple as banning share buybacks attached to industries who accept funds during this time?
Well, I mean, my view on that is that Elizabeth Warren is not exactly one of the world's great macroeconomists. She's a politician, and she has the courage of her convictions, which I mostly don't agree with. But with respect to dealing on the economic side of things here, I think the key is to try and get this thing handled and ring fenced in whatever way that we can. I think we saw with some of the stuff that happened in 2008 and 9 with Dodd-Frank and some of the measures that were taken there, they've had to be at least partly or in many of them wholly unwound because they were done amidst high emotion. And just like the TARP, which was a fantastically successful policy, but terribly unpopular politically, but TARP put an end to that panic. There were no bank failures after TARP came in there. So I think we've got to look at how, with respect to each industry, what the best way to protect the industry and the economics, and then obviously people's jobs and livelihoods. And again, in that case, I would pay attention to the people that actually, I think, understand the economy very well. People like Larry Summers, for example, or Greg Mankiw, or there's a whole host of people out there on both the left and the right and in the center that I think could probably come to some level of agreement about what the optimal policies are.
All right, Sybil, I appreciate you kind of answering all those big picture questions. I'd like you to talk to us now about how you're trying to improve your investments and where you think you'd put capital to work here.
Sure. One of the things I've heard, Kelly, on CNBC, as many people have been interviewed, is they say, well, if they're inclined to buy it all in this, they're saying, it's a good time to upgrade your portfolio, and if there are names like Nike or Disney or these high quality names that you wish you had owned, but were too expensive, now's the time because they're on sale. And there's nothing wrong with that advice. But I tend to look at things differently and say, what I want to do when I mean upgrading my portfolio, I want to adjust my portfolio for the price changes that have occurred so that when the recovery happens, whether it happens in 3 months or 6 months, whenever it happens, that we're positioned to get the maximum return when that happens. And so part of what we're doing right now is taking a look at businesses going back just before the coronavirus hit, and seeing where they all traded. So that was a period, the U.S. economy was very strong. It's not going to be strong now, but certainly could not have been in a better place to to have this thing happen, because unemployment at a 50-year low, inflation not a problem, interest rates down, corporate profits at all-time highs. So a good, solid economy, and we would take, and we have taken, basically a look at what where things traded in January and in early February, and then looking at what's down the most, and then adjusting for financial risk, balance sheet risk, and stuff. Try and get things that we think can go up the most when that happens. So that, and what's been hit the hardest have been obviously things like companies with leverage, companies that are smaller in market capitalization. The stuff that's held up the best are the obvious beneficiaries of stay at home. In that high quality category, though, that everybody regards as high quality, I think that if you didn't own Amazon, this would be a great time to buy it, because it's no secret that Amazon is going to benefit from all of this. But I do think what's remarkable is that they're going to hire 100,000 people, and that's about roughly 10% increase in their workforce, which gives you a sense of just how powerful the orders have been. And this is, of course, happening all around the world. And the impact of this will be that people that were, either not Amazon customers or were sporadic customers will be ordering more. And once you start ordering more, you're going to join Prime, which is the huge flywheel that Amazon has. So this, all of this activity to deal with the coronavirus that countries are taking could be relabeled the Amazon Subsidy Act of 2020.
Right.
And
well,
so I think,
which is not great news to kind of main streets across the country. I'm sure. I mean, I can hear that. I hear that outrage already, saying, they're hiring those workers basically from local businesses. I don't really want to get you bogged down in that, though. I actually wanted to ask about some of the financials. Bank of America, Genworth, these companies that could be permanently damaged by if rates stay where they are. I mean, what would you do with those holdings?
Well, those are in our top 10 names. So let me just take the first one, which is Genworth. Genworth has gotten approval finally to close the deal with China Oceanwide, and so that's an arbitrage right now, and it's one of those things that gets kicked up when the markets are in complete disarray. So it looks to us like, so they've got basically all the approvals that they finally need. They have to put $100 million more into one of their subsidiaries to satisfy the New York regulators. But Genworth's the deal will close. They hope to close it by the end of this month, so in a couple of weeks. And the price is $5.43 in cash, and the stock is around $4 today. So that's, call it a 30 to 40%, 35% return in 1 month. If they close it on the 31st, it's been hanging fire for 3 years, but the 31st, if it's not the 31st, it'll be a few weeks after that.
What about Bank of America? And I have so many more questions. I know we're going to run out of time, but I know BofA is a wide holding for people.
Yeah, I mean, all of the big banks are under a lot of pressure because of the net interest margin squeeze and all the turmoil. But the Fed is, the most important thing here is the Fed is going to make sure that the financial plumbing is operating, and that's what it's doing. The banks will have plenty of liquidity, access to the discount window, and otherwise. The primary dealer facility was reactivated yesterday. So yeah, the banks, like everything else, is sort of the correlations have gone. As my son who runs our income fund says, the correlations have all gone to one here. So everything is going down. Mm-hmm. And the banks, I think the banks are great opportunities if you don't own them. They're in the strongest financial position in history. Brian Moynihan's done a great job with Bank of America. So, we also own J.P. Morgan. We also own Citibank.
One more for you. What about American Airlines, especially because of both the leverage piece and the fact that they're going to face a months-long, if not quarters-long, business hit here?
Yeah, American is in the weakest position. We have been adding to it down here. We also own Delta. We also own UAL. The one thing that I think you can say with confidence about certainly Delta and United Airlines is that I would put it it'd be almost impossible for them to go bankrupt. And the reason I say that is Warren Buffett owns 9 or 10% of each of those, and Warren bought more Delta stock in the 40s recently. Yeah. And I would be highly confident that if those guys needed help, he would be there with his standard 8% preferred with warrants, and he's got $130 billion on the balance sheet. So I wouldn't expect any issue with those, except just the price changes that we've seen. Well, and again, I think.
Go ahead. I was just going to say, for American, does it become a survival of the fittest, consolidation? consolidation? You know, I'm surprised there hasn't been a better reaction to more details coming out about what these emergency loans from the government will look like. Investors don't seem to care.
Yeah, I mean, investors don't really care about anything right now. They're in a panic mode. I think the differentiation, you should begin to see some differentiation as this panic winds down, and then people will be able to sort out, you know, what sort of bailout, if it occurs, what sorts of lines of credit will be given to the airlines, and then what will the terms be, and we'll just have to wait and see on that.
And so finally, Bill, before I let you go, to reiterate, you look at these markets and think that the declines at this point are near an end, that the selling pressure is about to abate, and that this is a historic buying opportunity, one of the top 5 you've seen in your lifetime?
Yeah, I'd come back to 2008 because, as you may recall, and your viewers may recall, in October of 2008, Warren Buffett wrote an op-ed saying, you know, buy American stocks, urging everybody, saying he was buying stocks and urging people to do the same thing. And of course, people didn't do that. They kept selling stocks. And it's the reason that Warren is the richest guy in history, having made his money all in the stock market, is that typically, and one of the remarkable things to me is when he says to buy, people don't do that. They do the exact opposite, which is why he has all the money and they don't. But he was asked, I was at a meeting with him a few years later, and somebody said, how did you know that was the right time to buy stocks, you know, in the fall of 2008? And he said, I don't know time, I know price. And he said, I know when stocks are cheap and when they're bargains and when they're not. And he said, so I buy them when they're bargains. And I would say the thing here, I think stocks are cheap, they're bargains. Can they go lower? Absolutely. You know, we're down 30-some%. We were down peak to trough 50% in 2008 and 9. You can't rule anything out. But certainly these prices, I think, in the context of a normal environment, are extraordinarily attractive. I mean, we were looking today, we don't own it. We don't own it yet, I'll say. We don't own Carnival Cruise Lines. But Carnival today is trading lower than it did in 2001, you know, at 9/11, lower than it did in 08 and 09 when it bottomed in the teens, and it averaged around $20 a share during that period of time, and now it's a single-digit name. It's an investment-grade credit. You know, it's better capitalized than the other cruise lines. So those are the sorts of things, if you're looking out long-term, it was $50 in January, and now it's, what, 8 or so, 8 or 9?
Yep, about
so
8,
I think those are the sorts of things. Yeah, those are things you have to be looking at now. Whether you pull the trigger or not, they've got to be on your list. I
finally, what's your message, Bill, I get friends, neighbors, family saying to me, I'm not putting my money in this market. I don't trust it. What's your message here to the folks listening?
Well, again, if people can't take the risk, they have to be able to invest where they're comfortable. But I would say if people are interested ever in being invested in the stock market, which has provided the best rates of return over long periods of time of any asset class, then now is certainly the time to start into that. And again, I just go with an index fund. That way you don't have to worry about active managers, you don't have to worry about costs, and you will participate in the inevitable recovery whenever that occurs.
Bill Miller, thanks for joining me today.
Okay, thanks.
Bill is the chair and CEO of Miller Value Partners. A lot to digest there. What an hour it's been. As I mentioned, we did reopen stock trading during that interview. The Dow is still down about 8.5%, 18 and 28 points. A little bit of differentiation between the Dow, S&P, and NASDAQ today. And there's all the major averages. The NASDAQ is down about 6.25% right now. The S&P is at 2339. A lot of people were watching the 2350 level. So 2339 is where we are, down 7.5%. And it's a worse picture in oil right now. Crude is cratering again. It's hard to say it, but building on its worst month ever, it's crushing the energy sector. That does explain some of the action today. WTI crude just hit an 18-year low. It broke $22 a barrel. We're now at $21.67. The outlook for fuel demand gets bleaker by the day, of course, with more travel restrictions and social lockdowns. The whole sector is down more than 40%. Let's bring in Brian Sullivan. Brian, you rightly keyed into the Saudi story, the supply aspect of this yesterday as well, which seems to be making things worse today. But we're down basically 20% in oil again here, and the journal's talking about we could go below $10 because there's a global storage glut.
Well, they must be watching CNBC at the Journal. I mean, this is when you have a barrel of oil that nobody needs or wants, and all the storage tanks are full. That barrel has either zero value or even negative value because you've got to pay somebody to take it away to maybe store it if you don't have room for storage. We're not there yet, obviously, but crude oil, Kelly, is below $22 a barrel. And nobody I've talked to thinks that we're going to move up anytime soon. Now, of course, like Bill Miller was just saying, when everybody's on one side of the boat, maybe that's when you got to start looking. But of course, oil is for by and large a commodity, and we're below 22. The XOP's down 9%, and there's a lot of oil companies that used to be worth $5, $8, $10 billion that today are worth $50 million and are basically priced at a zero.
It's wild, Brian. So here's the question. Why are the producers taking this moment to try to crush it? You know, if I were Saudi, if I were Russia, I mean, the news is bad enough. If I were a U.S. producer, obviously, but there seems to be a big geopolitical aspect to this. What do you think this is all about? What's the end game here?
Well, I wrote about it a couple weeks ago. I mean, the Russians want to go to war with U.S. shale. And now the Saudis are going to go to war with the Russians, and we're caught in the middle of it. But we are the marginal producer. I mean, we have doubled our oil production in the last 10 years, and I think the Saudis and Russians sat by and were like, okay, this shale thing can't last. They're going to run out of money. It's debt-fueled. But it kept going up, 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 and up. And now I believe there is this idea that, listen, let's just crush these weaker companies while we can. Hopefully production will come down in the United States, because to Bill Miller's point, I mean, I'm not an equity analyst. It's not my job. But I will say this. There are companies that will survive this. Many oil companies are going to go away. Not my opinion, written by pretty much everybody out there. The equity is effectively a zero already. So there will be survivors. But I think the Saudis and the Russians, Kelly, they want production to come down. They want kind of the world to be broken into four things. The U.S., sort of OPEC, Russia, and then kind of everybody else. And the U.S. has been barging in through the front door, and I think they're trying to slam the door closed.
Fair enough. Well said, as always. Brian, thanks. It's good to see you. We really appreciate it today. Sure. Brian Sullivan on these crazy, big moves in oil. Some breaking news on the housing front right now. Let's get to Diana Olick. Diana, what's going on?
Well, Kelly, just moments ago, the FHFA put out a notice directing Fannie Mae and Freddie Mac to suspend evictions and foreclosures for the next 60 days. Response to the coronavirus. Now, I spoke with FHFA Director Mark Calabria about borrowers who are concerned about making mortgage payments. Fannie and Freddie are now telling mortgage servicers to offer loan forbearance to anyone affected financially or otherwise by coronavirus, which means a borrower can miss payments, which would then either be paid out later or tacked on to the end of the loan. But Calabria added, we are on the front end of this. We don't know if this goes more past the summer. Certainly, it's going to call for a different set of responses. As for a halt to all mortgage payments, which was done in Italy, Calabria said the White House or Congress would have to lead on that. Now, several cities, including Denver, Seattle, San Francisco, and San Antonio, as well as New York State, had already put a ban on evictions from rentals or foreclosures. At Wells Fargo, a spokesperson said they have been getting calls from concerned borrowers and are currently providing assistance, including fee waivers, payment deferrals, and other expanded assistance for credit card, auto, mortgage, small business, and personal lending customers who contact us. There is already concern now, though, that the mortgage servicing industry is not equipped to handle the onslaught of all these calls. And just as we were about to go on air, Kelly, I did get a response from J.P. Morgan Chase. They are also offering forbearance to any customers who call, saying that they are having trouble making the payments due to loss of income. Kelly.
You know, Diana, one kind of side note, although it normally wouldn't be, it's just that the action has been so crazy, has been what's happening with mortgage securities, I should say. In other words, they're not trading that well the last couple of weeks. Even though bond yields have plunged, you know, these things have not followed them down. The rates have started to back up a little bit. And I've got some people who are in the market saying to me, announcements like this, while they help the economy and homeowners, will they make the mortgage market worse and maybe hurt the ability to push those rates down in the long run?
Well, look, the rates have been all over the place in the past 2 weeks. We saw them drop 2 weeks ago to a record low. Then you saw this massive flood of refinance applications. The banks couldn't handle that. Investors were concerned about prepayments, so they weren't buying the MBS, and that pushed rates back up again. So now we're back a little after we saw the federal stimulus last Sunday put in place, and you saw those rates start to come down, but again, yields are up again. They're literally all over the place. But I think important to focus on now is not whether you can refinance your loan, but whether you can make that mortgage payment, and that's what's being addressed now.
Yeah, for sure. All right, Diana, thanks. Diana Olick Let's get the very latest on the coronavirus count now. It has spread to all 50 states here in the U.S., and Sue Herrera has the latest for us. Sue?
Indeed, I do, Kelly. Thank you very much. Here's what's happening at this hour, everyone. New York's governor is reporting 1,000 new coronavirus cases since yesterday. That takes that state's total above 2,300, and that's about double the cases in Washington state, which has the second highest count. Governor Andrew Cuomo also announcing the USS Comfort, which is a Navy floating hospital, is being sent to New York. Worldwide, the number of confirmed cases is now above 207,000. The U.S. and Canada have agreed to temporarily shut their mutual border to non-essential travel. Canadian Prime Minister Justin Trudeau says, though, trade will continue.
Supply chains, including trucking, will not be affected by this new measure. Canadians and Americans cross the border every day to do essential work or for other urgent reasons. That will not be impacted.
And British cabinet ministers meeting to discuss new stimulus measures there. Prime Minister Boris Johnson says every worker will receive support. The government is also working to protect people from being evicted from their homes. Johnson says Britain is increasing testing capabilities to 25,000 tests per day. Meanwhile, the Scottish government says all schools will close this Friday and they may not reopen before the summer.
Wow.
You are up to date, Kelly. I will see you next hour with more.
Okay, Sue, thanks very much. Sue Herrera there. Let's turn back to the market where stocks are selling off again sharply today. In fact, we were halted at the top of the hour when the S&P fell more than 7% for the first time today. Now you can see the Dow down nearly 10%. It's well below 20,000. It's at 19,123, and there's your 10% decline. The Russell 2000 small caps, as has been the case, down 11% today. Even the NASDAQ and the S&P down more than 8%. Just a little technical note, a lot of folks are watching the 2350 level on the S&P. Now we just hit 2,300. So all 11 sectors are in the red there. Energy, as we just discussed with Brian, a terrible session for crude. That's the biggest loser in terms of sectors, along with industrials. There are a couple of bright spots in the Dow, relatively speaking. Walmart is one of them, helped by an analyst upgrade. Walmart shares are up 1.5%. Walgreens, Cisco, and P&G are also in the green right now. In fact, Walgreens is up nearly 4%. The biggest weight on the Dow right now to the downside is Boeing. The stock is down 27% again today. Let's take a look at Boeing, which is well below $100 a share now. In fact, 89.10 is the latest print. That's a 67% plunge in the past month, and it's on track for its worst month ever. The company's saying it's in talks with the administration right now about short-term support because it had completed the drawdown of the rest of its nearly $14 billion line of credit. In fact, for more on this story, now let's bring in Phil LeBeau. Phil, just a terrible story for Boeing here, despite the president's assurances of support.
It is, Kelly, and I hate to be one of those people who says, well, the Boeing news is one that we'll get to in a little bit because it's terribly important. But I want to first update you on the news that we broke just about a half hour ago regarding the auto plants that are going to be shut down here in North America. First of all, Ford now sending out a release confirming what we reported, that it will be stopping production at the end of tomorrow's shift. So the second shift tomorrow, that'll happen all the way through March 30th. By the way, we also expect to hear this afternoon that GM and Fiat Chrysler are going to be shutting down their plants as well. Remember, they met with the UAW yesterday. UAW said, shut it down. They said, well, how about if we down production? We do every other shift. We also do a deep cleaning. Now the companies are realizing they're just going to shut their production down in North America. We'll have more from the automakers throughout the afternoon, I'm sure. Now let's shift to Boeing, which is a terribly important story. And Kelly, you showed how much the stock is down, 67% in the last month. Here's where things stand with regard to Boeing and its negotiations or its request for aid from the Trump administration and from the congressional leaders. They would like to see at least $60 billion in aid going to Boeing, but it's not like it's going strictly to Boeing. It's also going to the aviation suppliers. Remember, 70 cents of every dollar that Boeing is going to get, it would be then going on to the suppliers. Their point, you've got to help the suppliers out, or else we're going to see the aerospace system essentially collapse in this country. And what's killing Boeing, the airlines, not only here in the U.S., but around the world, they are getting crushed right now. So you have to wonder about future deliveries. How bad is it for the U.S. airlines? Let's start first off with Delta, dropping an 8K within the last couple of hours, on pace to lose $2 billion in revenue this month. $2 billion hit in revenue this month, cutting capacity by 70%. Remember, a week ago they said they're going to cut capacity by 40%. Shows you how quickly things are changing for Delta and other airlines. JetBlue, also out with an 8K today. On Friday, they took out a $1 billion term loan. They said today that they went through that $1 billion. They drew down the loan by Monday. 3 days is how long it took them to draw down that loan. Spirit, ticker symbol SAVE, it is cutting its April capacity by 20%, cutting the May capacity by 30%. And finally, take a look at United. It is increasing its April schedule cuts by 60%. Bottom line is this, Kelly. Nobody's flying. Nobody's booking. And the cancellations keep increasing. And as a result, you see the airlines ratcheting up their expectations in terms of schedule cuts. And I know people are probably saying, well, how much more can they cut? You've already cut 70% of your schedule. Well, there's another 30% there. And you have to wonder, you know, does the administration at some point say, yes, they talked about putting $50 billion aside, Kelly, for the airlines. When does that get passed? When is there the reassurance to the airlines that there is going to be some type of a backstop? And then what comes with that?
Phil, it's a lot. It really is. It's a lot to digest for all of these critical sectors of the U.S. economy. We'll just leave it there, Phil, and we'll get back to you, obviously, as we continue to get news both on the automakers and on the airlines. Confusion and concern reign not only in those industries, but in others, including restaurants, shopping malls, as there's been a lot of mixed messaging from governors and even the national government about what's to stay open at a time like this and what's closed. For more right now, I'm joined by Mitch Daniels. He's president of Purdue University and former governor of Indiana. He's also a former director of the Office of Management and Budget under President George W. Bush and a former senior advisor to President Reagan. So, Governor, it's great to see you now. We sorely need leadership, not this back and forth between governors and mayors and county executives over what's open and what's not. How do we better communicate to people about what to do at a time like this?
Oh, I'm not too inclined to second guess, having lived it the last week with new information every day and new guidance, scientific and medical guidance, leaving the government. I think looking back, Kelly, later, we'll fault ourselves more for the steps we didn't take in the last decade or two, the preparatory steps we could have taken to be more ready when this fully predictable event happened. The way we've been dealing with it recently, yes, I'm sure that some folks could have acted a day sooner than they did, or here and there more wisely, but I think in general, I'm impressed really with the swiftness of the national response. Not easy without totalitarian controls.
You know, Governor, I'm going to try one more question with you. Hope we don't lose you here. But when you're the first person I've heard call this a predictable crisis that could have been fixed over the past couple of decades. Are you referring to, you know, having a supply of face masks made in America? I mean, what do you mean by that?
Well, people have forecast that a pandemic was a when, not if phenomenon. Yes, there were things you could have done. We could have stockpiled antivirals. I mean, we're short of swabs right now. We hope that testing will be much more here soon, but some could have been done in advance weren't. So I think in the inevitable after-action reports, we'll look at ourselves more critically in that area, and we'll, I hope, take action so that when something like this comes around next time, we're much better ready to deal with it.
Yeah, Governor, I apologize because your sound's been dipping in and out, but we certainly get the gist of what you're saying. We'd love to check back in with you because I wanted to discuss what's happening with your university and others here. But if you would be so kind, maybe rejoin me as we get these wires open again. And we thank you very much.
Thank you.
Governor Mitch Daniels, apologies about that. While activity has picked up in the stock market here, it has also picked up a little bit in corporate credit, and that's specifically in the high yield or junk part of the market with a rise in activity. So what's going on with the stresses there? Let's bring in Dom Chu from his home bureau. Dom, it's good to see you again, even at a distance here. This is a really important topic. So what are you seeing out there in the credit markets?
All right, so there are stresses happening, and what's a little bit more curious over the last couple of days about the price action, so specifically in corporate credit in that world, is that we have seen kind of like that divergence or convergence that we've been looking for happen again. The first thing I want to key you in on is an interesting chart put together by the data and research folks over at White Charts. And what this chart shows is the corporate risk curve and what it looked like from AAA bonds all the way to CCC bonds, that is to say highly rated corporate bonds to less highly rated or more junk rated debt. One of the lines on the top shows you what it looked like in terms of the interest rate curve across that span back in the great financial crisis in 2008-2009. And then the two lines below it are this year and its stress points in the last year as well. The thing that you want to key in on is not the absolute level of interest rates across that curve, because we know back in 2008-2009, interest rates nominally were a lot higher than they are today. But what I want you to key in on is the right-hand side of that chart, where you get more towards the junk and levered side of things. Those particular steepnesses that are happening have not yet happened in this particular crisis in the corporate credit market, nor did it during times of stress in the last couple of years as well. So there is a precedent that we could see even more pain, specifically targeting the junk or high yield part of the corporate portion. That's going to be something to watch. Also, what to watch here is the difference in yields between AAA rated, very highly rated bonds and CCC rated or junk debt. So far what we've seen is that AAA rated debt has been doing pretty well. If people continue to buy it for that yield, and for that reason, it's been relatively safe. After that, though, look at the CCCs. We have seen a big amount of stress there, so it's certainly two flashpoints in the corporate debt market, Kelly, to keep a close eye on. We're certainly doing so here at CNBC.
Yes, sir. Dom, thanks very much. Dominic Chu for us. Let's turn to the casinos, which are also taking it on the chin today after the Nevada governor ordered a 30-day statewide shutdown. Contessa Brewer has those details for us. Contessa, got to be a worst-case scenario for the casinos, for the whole Vegas Strip.
I mean, and it's not just Nevada. Right now, we're seeing these casinos shut down, Kelly, coast to coast. But Nevada, casinos and tourism, that's the economic lifeblood of this state. According to the University of Nevada, Las Vegas, there are 100,000 people who work on the Las Vegas Strip alone. And as they shut down these casinos at the order of the governor, who says that all non-essential businesses have to close, you know that these guys are going out, going home, and wondering what's going to happen. Well, at this point, if you've got 450,000 people working in travel and tourism in the state of Nevada, according to the Nevada Resort Association, this is an industry worth $68 billion. It's very important to know what happens to all of these people. Well, Las Vegas Sands Station Casino says they will pay their workers. MGM Resorts has already announced some layoffs and some furloughed workers, but says it will pay those furloughed workers, even the ones who are part-time, it will pay them for 2 weeks. Wynn Resort says it will pay its workers for 30 days. And in a video message sent out to employees, CEO Matt Maddox explained why he's willing to pay workers to stay home.
If you take our families, we represent about 50,000 people in our houses. And the 50,000 of us, if we do what we're supposed to do, we're going to save lives.
There's a big question now about liquidity, insolvency, and the analysts are coming through with estimates at the low end. We have Penn National that some analysts say maybe only has 4 months of liquidity. But on the other hand, you have Las Vegas Sands, which is at the upper range and says it's well-positioned, financially stable, can take care of its employees. Caesars included on its note that it's sitting on $2.8 billion cash on hand and is doing other cost-cutting measures. So we'll wait to hear about those. Barry Jonas of SunTrust sent out a note today, and he said, look, if you think that gaming is a place you want to be, look at those REITs, because even though their share price is taking it on the chin, as you said, Kelly, in this case, they could go between 43 months to 81 months without getting any rent from their casino tenants and still be okay.
Wow, that is a great stat. Contessa, so when you mention, I'm curious how this is all going to play out, but a lot of these places are going to keep trying to pay workers. Do they say for how long? And I wonder in some cases if it's going to be tough for people who might say, you know, I could collect unemployment benefits, but now, not to say they're stuck in limbo. Of course, they'd rather be paid, but I just wonder how long that situation can last.
And I think it really depends from company, because Caesars told me they're still trying to work out how can they minimize the impact on their employees, and they're not being clear about that right now. MGM has said 2 weeks, Wynn has said 30 days, and Las Vegas Sands just says blanket, we're going to pay our people. It probably depends a lot on the balance sheet, a lot on how long that they are kept out of this. But in Nevada, the close down is 30 days, so it leaves people going, okay, well, what happens after 2 weeks of being furloughed from my job? And then what happens if the closures have to go on longer than that? Kelly, in Macau, we know that the casinos were shelling out up to $2.5 million per day on paying. Most of that was going to salaries, operational costs, utilities, and things like that. So they're not getting any money in, and they're bleeding money out. It's a crisis point.
It is. And like everything, it depends on what happens with coronavirus here nationwide. Contessa, thanks very much. Contessa Brewer for us.
Sure.
Just want to bring you a quick news alert. Prime Minister Boris Johnson saying just now that England will shut its schools due to coronavirus. As of Wednesday, the UK had more than 2,600 cases confirmed with 72 deaths. And now the whole country taking that step to close its schools, which again, here in the US, many have already done on a state-by-state or a municipality-by-municipality basis. Coming up, my next guest says this is a whatever-it-takes moment, and there's no limit to what the Fed or fiscal stimulus should do. What does he want to see happen next? How big a price tag? We're going to ask him with the Dow down 18, almost 1,900 points. We're back in 2.
During the last few months, there's a lot more purchase of daily use products like grocery, household product, healthcare, and that's really a reflection of increased usage. As we can see, last year we announced 362 million active users. In Q4, we have almost 26 million of new customers, and I think this is going to continue, especially since we are able to continue to deliver during the time of crisis.
People have been looking for love online for more than 2 decades, with the website Match.com launching in 1995 and the gay dating app Grindr launching in 2009. But advertising for a partner goes all the way back to the 17th century, shortly after the advent of the newspaper, when bachelors ran personal ads looking for a suitable companion. It's believed the first woman ran a newspaper ad in 1727, stating she was seeking someone nice to spend her life with. Lonely soldiers during the First World War advertised for pen pals. And in the 1960s, technology got involved. Operation Match was a computer dating service invented by Harvard undergraduates in 1965 that paired people up based on a questionnaire. That all changed in 2012 when Tinder invented the swipe. People swipe right when they like the look of someone, or left if they're not so sure. When two people like each other, it's a match, and they can then start messaging.
Welcome back. Let's get you caught up where we are in these markets right now. Deep in the red, long story short, the Dow's down 1,850 points. That's an 8.6% drop, and we are down 10,000 points since the record highs. We did trigger the circuit breakers with the S&P 500 when it fell 7% around an hour ago, so we halted trading for 15 minutes. That's where we stand now. Part of this drop today coming from energy stocks, which are sinking as oil falls to an 18-year low below $21 a barrel. And in the last hour, we heard from Bill Ackman, who said, quote, hell is coming. Bill Miller, meanwhile, telling us just now that this is the buying opportunity of a lifetime. So who's right? For more, I'm joined now by Jason Trennert. He's chairman at Strategas Research Partners, and Julia Coronado is founder of Macro Policy Perspectives. And it's good to have you guys both here. Julia, let me start with you on the economy. I've seen second quarter GDP figures now of -10, -13%. Is that outlandish or totally feasible?
It's not outlandish when we're talking about the economy effectively grinding to a halt right now as we speak, and this is going to last at least several months. I don't think it's outlandish to think we're going to see some of the biggest one-quarter drops we've seen in the post-war period.
And, this sets up for a unique challenge because it's almost like the country was hit by a virtual meteor, right? So there's a lot of talk about what happens kind of in the rebuilding effort, right? And in a way, that could be as tricky a period of time if you're in the market, for example, but trying to figure out inflation and how to unwind some of these programs. I know I'm way ahead of myself here, but it's going to be a dicey few months.
Yeah, no, it's a liquidity crunch in the real economy. So businesses are looking at revenues just stopping on a dime, and households, meanwhile, still have rent to pay and mortgage payments to make. So it really is something that can feed on itself, and the goal of policy right now should be to short circuit that feedback loop. And if you think about the scope of this and the scale and the speed with which this is happening, it's going to take a lot of money, even more than they're talking about on Capitol Hill right now, and more from the Fed. And it's rippling through financial markets in a very insidious way. We're hearing about deleveraging and forced selling.
Right.
We're seeing breakdowns in the correlations between stocks and bonds. So we really are at a moment where this could feed upon itself in a very bad way, and policymakers need to just break it all out, be creative, go big, and arrest this feedback loop.
Jason, let me bring you in on that note. Are you someone who would also say this is the time not to worry about the dollar figure per se, because the cost is going to be huge if we do nothing? I don't think people understand what a recession means for the budget, for the deficit, for the debt. I mean, it could be spend less now on that front, or spend a whole lot more later if we can't get this thing back on track pretty quickly, right?
I think that's right, and I think there's been a very big change in the administration itself just in the last 2 weeks, certainly in the last 4 or 5 days, where there was some talk of targeted stimulus, a week and a half ago, and now it seems to me this is like Draghi said in 2012. This is very close to the whatever it takes moment. You've passed an $8.5 billion spending bill. $105 billion spending bill is about to be passed, and you're talking about $1.2 trillion. Maybe you're right. It may need to be more. It seems to me, though, that there's no upper bound in what policymakers are willing to do now, especially with 10-year Treasury yields as low as they are. There's not much cost. I would argue for doing whatever it takes.
People will push back. They're already pushing back. I think in part because we haven't seen the hit yet that's coming to the economy, and say, how can you say open-ended? How can you be throwing around multi-trillion-dollar figures out there? Explain why, and maybe this is dangerous, and that's why we have to worry about what this will look like on the other side, and maybe that's why the bond market's already going a little haywire.
Yeah, well, it clearly, this is a form of modern monetary theory. There's no two ways about it, and that can be somewhat worrisome as far as inflation is concerned later on. But by the same token, we have to get, I would suggest very much a one day at a time approach. And Sinatra said, "I'm for whatever gets you through the night." I'm very much for whatever will work in the next couple of months, so the liquidity crisis doesn't become a solvency crisis, which it seems to be morphing into if we're not careful. So you've never seen, it's cliche to say it's unprecedented, but you've never seen largely a government not mandated because we have a free economy, but largely mandated demand shock.
Exactly, and they have to compensate people for that. You can't order things closed. Right, exactly. And let me ask you too, Jason, because we're running out of time. This Bernanke-Yellen op-ed in the Financial Times, I want to make sure everybody knows about it and reads it. Along with the litany of things they recommend, they do say the Fed could, and in fact, you could say they're saying they should buy corporate debt. Would you agree with that?
I would. It's hard to be. There's no atheists in foxholes here, as they say, and you can't be intellectually pure. It's not what the Fed was designed to do, but again, this is different, and I would suggest I would want to make it a permanent feature of our central banking. But if you're going to pull that, if you're going to pull that lever, this is the time to do it.
Okay, and Julia, I want to make sure everyone heard what you said because I thought it was the best encapsulation of this I've heard yet. Quote, a liquidity crunch in the real economy. And that helps explain why we're trying to get liquidity to households directly, right? No matter, however that has to be worked out. Yeah.
Absolutely. And in addition, let's throw in municipal bonds in there. State and local governments are on the front lines of addressing the health aspect of this, and they're going to need access to funding. Give the Fed the authority, at least temporarily, to help finance them. That will can help a lot of problems and help us get through this.
Holy moly, that's all I'm going to say for today. Julia Coronado, Jason Trenner, thank you both. We do very much appreciate it, tracing the outlines of this crisis for us. Coming up, we are going to speak with Massachusetts Senator Elizabeth Warren about the government's proposed $1 trillion+ stimulus package and the potential bailout of the airlines and Boeing. Don't go anywhere. CNBC's breaking news coverage continues on the other side of this break.
They said it will never work. We still hear it all the time. But we built it anyway, client by client, market by market, for bonds, derivatives, money markets, ETFs, and equities, into a global electronic trading network that connects every part of the financial community. That's second to none. It will never work? Well, now it does.
Artificial intelligence is about sensors. Devices become remotely machine addressable. Vibrations, temperature, and then we can apply machine learning and solve classes of problems that were previously unsolvable. 10 to 20 years out, we're looking at highly censored human beings. Devices attached to the heart in the cerebrum that will do everything from monitor blood chemistry to allow people to communicate almost telepathically. This is the future of business. I watch CNBC.
Advertising firm S4 Capital says it has not yet seen a material impact from coronavirus to its 2020 operations. The group has delivered £215 million revenue.
This is a disruption around an event and is not cyclical or structural. In this maelstrom, the weak are going to get weaker and the stronger are going to get stronger.
Coming up on Mobile One The Grid, Max Verstappen enters his 6th season in Formula One. Elvin Evans gets his big break at Toyota. And Nick Tandy goes for the hat-trick at Sebring. Catch it all on Mobile One The Grid.
Good afternoon, everyone. I'm Tyler Matheson, and we start with breaking news on the major market sell-off that you see right there, down 1,958 points. We are at session lows a moment ago, just as we were in break. The Dow dipped below that 2,000-point level of loss. Trading, by the way, halted for 15 minutes in the 1 p.m. hour as the S&P 500 fell 7% for the first time today. Now, coronavirus fears, of course, reaching a fever pitch as the government works to pass a massive stimulus package. The voting on that is coming up very soon. And look at oil in free fall yet again, down another 22%. Crude dropping hugely today as demand fears rise. That demand is going to fall, hitting its lowest level now since 2002. And speaking of free fall, look at shares of Boeing, that aerospace giant, asking now for a $60 billion bailout. It is down 25% today and on track for its worst month ever, doubling the losses it saw back in September of 2001. This stock was a $300 plus stock not that long ago, Kelly.
It's just unbelievable. Tyler, thanks. So appreciate it. Here's what you need to know, everybody. There are 100,000 cases of coronavirus globally. About 7,000 of those are here in the U.S. The U.S. and Canada have now agreed mutually to close the border to limit travel between these two countries. The move, they say, won't impact trade. That's been impacted by its own problems. New York is dealing with the largest outbreak of coronavirus, with its cases more than doubling to 2,000 overnight. We do have full team coverage for you. Bob Bassani is all over these big market moves today. Brian Sullivan is watching crude as it craters. Kayla Tausche is tracking the Senate as it works to pass phase 2 of the stimulus package soon here. And Rick Santelli on the bond market as the 10-year yield is now higher, 1.2%. Bob, we'll kick it off with you.
So we were comfortably down. I know that's a weird word to use, but comfortably down somewhere 6 or 7%, tooling along. And then a very important interview with Bill Ackman came on, and here's essentially where it happened, right about here. And you can see the market drifted down. Bill Ackman, the new Dr. Doom, as somebody down here once said. What caused this drop here? Listen to what Mr. Ackman had to say. Quite an emotional interview. They're going to be passing this around for the next couple of days. America needs a 30-day spring break, saying that the gradual rollout is not working. We all need to shut down the whole country for 30 days, and very aggressively saying so. And here's where it got really emotional. I'm not going to kill my father. I went into lockdown almost a month ago to save my father's life. I urge you to watch the interview. Very rarely do you get emotional interviews in the business world. This was one of them. Now, here's the big surprise he drops on everybody. You think this is a, well, sell the world kind of thing. No, I'm aggressively buying stocks. Everybody said, whoa, wait a minute. Now, unfortunately, this message got lost in the doom and gloom commentary that he had. He's aggressively buying Hilton, by the way. He's been a point of bringing that up here. Bill Miller, also one of the great value investors of all time, came out, one of the greatest buying opportunities in my life. He said something to the effect, there were 4 great buying opportunities in my whole life. This is the 5th one, something to that effect. So you get the point. Here's 2 big market gurus essentially telling you, and yet we're not particularly bouncing at all. Just take a look at the one chart I showed everybody all day about why the market is very unhappy and worried. Here's corporate bonds down. Here's the equity market, the S&P 500 down. Here's crude down, and here's oil down, and all down. And when all this happens, everybody says, huh? This means liquidation. This means people selling to raise cash. It raises all sorts of anxieties when all 4 of these sectors move to the downside. I have been asked about a couple things about the stock exchange. There is a comment from the New York City mayor that he may issue a shelter-in-place order, and what all of that means. I want to just bring up the circuit breakers first to point out the level 1 halt 7%. That no longer applies here. We'll go down 13% until 325, and then there's no halt 20% at the rest of the day. And the shelter-in-place, Kelly, I think even if it's implemented, probably would not apply to the New York Stock Exchange. I'm trying to get clarification on that, but that's my impression right now. Back to you.
Okay, Bob, thank you very much. Bob Bassani down at the NYSE.
Well, as we mentioned, oil is in free fall as well as equities, collapsing now toward $20 a barrel. It's not just pierced that already. Let's check in with Brian Sullivan for more. Hi, Brian.
Hey, Tyler, I don't know what you were doing in the year 2003, but it's kind of a time machine because what you were doing, well, oil is the same price now as it was then. That's how far we have come. Price of oil continues to fall. Global demand falling off a cliff. Global supply continues to go up. The Saudis have actually indicated they could go to 13 million barrels a day if they wanted to. Now, what does that mean? Well, they're at about 9.5 to 9.8 and going up. So the world demand is going down. Saudi supply may go up. You don't need to be an economics wizard to understand that that is a terrible combination. Now, a few positive points, I guess, on where things may go. U.S. companies continue to slash their costs, their capital spending plans. The average, according to Goldman Sachs, about a 28% cut. It's bad news for jobs. It's bad news for industrial supply. It's bad news for a lot of people. But if it can stabilize oil, some of these companies might get stabilized as well. And again, you know, I know I'm sort of the oil guy, but really I've said forever, and I'm going to say it again for the billionth time, it's a debt story. You got to take a look at certain bond ETFs. I'm only picking out 2 because they're the biggest, not because they're at any more risk. But the HYG, which is a high yield ETF, it's about 11% energy related, and the JNK, another one that has significant energy exposure. There are others, by the way, out there, and I wrote about them last week. You want to watch those because the credit markets may be far more important than the oil market right now. But unfortunately, guys, they are inextricably linked. I'm going to say goodbye. I'm going to burn some oil, drive up to the NASDAQ market site from my toll here in New Jersey.
Before you get in your car, is anybody making money in oil at this price? Are the Saudis making oil? And if they're not, why are they pumping more of it to sell at a loss?
You and your good questions, Tyler. That's what I've always liked about you. Okay, a lot of questions there. Nobody in America is making money at this price. I mean, there might be a couple wells that are producing that have been around forever that have a cash cost of $15 or something, but all in, no. The Saudis, their actual drilling, their sort of production costs are like $3 to $4 a barrel, but they've got all those societal costs that we have talked about. I mean, Qatar and Kuwait, they need $100 oil effectively to fill their budgets. Saudis need about 85 to 88. So they can actually make the oil, get it out of the ground, not make it, it's natural, get it out of the ground for about $3 to $4. But of course, that oil funds a lot of other things. I will say this. Bad time for two stocks. I mean, number one, Aramco. I mean, they went public a couple of months ago. The stock keeps falling on the Saudi exchange. And number two, and not picking on them again, but Occidental Petroleum, buying Anadarko last year, debt-heavy deal. Occidental stock is back to the price level it was in the year 2000. Buy 2K oil for OXY.
All right, thanks very much, Brian Sullivan. We appreciate it. Kelly?
All right, the Senate is getting set to vote on the final version of Phase 2 of the stimulus package. Kayla Tausche has that for us. Kayla?
Kelly, our eyes turn now to Capitol Hill, where we are going to watch a socially distanced Senate take up an elongated vote on the second coronavirus relief bill. This is the one that provides roughly $105 billion worth of paid sick leave to an estimated 40 million Americans. Senate Majority Leader Mitch McConnell has doubled the allotted time for this vote because he doesn't want lawmakers to be congregating in this chamber. Now, not all lawmakers have liked this bill. Senator Marco Rubio, the Republican from Florida, whose state is heavily exposed to tourism and the cruise industry, thinks fairly incentivizes companies to lay workers off instead of providing this benefit. But he said that the Treasury Secretary urged lawmakers yesterday to go ahead and pass this and then make any changes that they need to in any follow-up legislation, because the big deal is what comes next, and that is this $1.3 trillion stimulus bill that the Treasury is putting together and could send to the Hill as soon as the end of this week. I'm told that both the House and Senate bipartisan leaders are working with the Treasury to put together a clean bill that is easily passable in each chamber. And aides tell me that the soonest that could be taken up for a vote is Friday. That is the third phase of this stimulus. After that, it is likely that lawmakers would consider this new request for about $45 billion in agency funding after that. But aides I talked don't think that this is the last of the stimulus that they're going to see. Congress had expected to break and to go home to their districts after these stimulus packages passed. But one aide that I just got off the phone with said this is probably not going to be all we need to do. Even so, it is clear that the Treasury and the White House want to be able to move on to do that big stimulus package. And I'm told that the soonest that could be taken up for a vote in the Senate is Friday. Tyler and Kelly?
All right, so Friday then, again, Kayla, I don't know about you, don't you feel those flashbacks? 08, 09, I mean, the importance of these votes right now to the market, right?
They are critical to the market, Kelly. I mean, it is evocative of that TARP vote back in 2008, where it was the steep sell-off at that time that was really what scared lawmakers into submission. And even those that didn't like the content of the bill knew at that moment that they had to vote on it. But looking back, Kelly, at some of those levels, the sell-off in the Dow on the day of the TARP vote was a decline of 7%. I mean, that is not even close to the percentage drops that we are seeing right now. Yeah. The declines are much steeper. The urgency is much more strongly felt. That is not lost on the lawmakers I've talked to.
Yeah, you're right. More than 13% the other day. Okay, Kayla, thanks. We appreciate it. Kayla Tausche. Coming up, Senator Elizabeth Warren will join us from Capitol Hill to discuss this coronavirus outbreak and Washington's response, what she thinks the government should be doing about it.
And meanwhile, Kelly, the bond market holding up just a bit today. Santelli, that would be Rick, is at the CME. Hi, Rick.
Hi, Tyler. Just looking at where the yield curve set up, so enlightening. 2-year right now are down 3 basis points. 10s are up 10 basis points, and 30s are up a baker's dozen, 13. So you see the steepening. The long end, maybe there's a little religion with respect to debt. You know, there's a price to issue debt, especially debt that's being issued after we have boatloads of debt already issued globally. And as you look at a chart of 10-year, since the Monday lows of 31, here we sit basically up 400% from an intraday perspective, of course, and we still haven't gotten to the 5:30 a.m. 122 level, but we're getting close. TY VIX, it's like the VIX for the stock market for 10 years. Look, back to 2007, we're hovering just under 14, which is the cycle high, pretty much equates to 2008. Now let's go all currencies here. Euro versus the dollar. You know, 108 today is the low. If it was just a little lower, around 107.85, we'd be back to the lowest levels versus the dollar on the euro side since April of 2017. If you look at pound versus lowest levels since 1985, and finally the dollar yen. What just since the 5th of March, look at that bounce. It went from cycle lows that took you back to 2016 to almost freshly about where we closed the year. So big bounces. The dollar seems to be king, and not necessarily for good reasons. Dollar funding is a huge issue globally. Tyler.
All right, Rick, thank you very much. Stocks, of course, tanking with the Dow now on pace for its lowest close since December of 2016. Yes, 2016. As Bob mentioned a couple of moments ago, last hour, Bill Miller said this is the buying opportunity of a lifetime.
There have been 4 great buying opportunities in my adult lifetime. The first was in 1973 and 74. The second was in 1982, the third was in 1987, and the fourth was in 2008 and 2009. And this is the 5th one. So I think this is an exceptional buying opportunity. I don't mean to put all the money in it at once, but I do think layering it in right now is the way to go.
All right, let's bring in David Kelly, Chief Global Strategist at JP Morgan Asset Management. John Bellows is a Portfolio Manager for Western Asset Management. David, let me begin with you. Is Bill Miller right?
I think it is a buying opportunity. I don't think it's as good as the buying opportunity in 2008, 2009, because I think we do have a long way to go to wade our way out of the social distancing recession here. I think it's good. I think 2021 will really be the year of recovery. I don't expect to see a significant economic recovery this year, but I think he is generally right, though, because we have seen stock prices come down very far. We've seen valuations come down, and remember, we will see the earnings going to be atrocious this year. But the idea is basically to keep the economy in sort of suspended animation, and that's really what fiscal stimulus is all about. Keep workers basically getting by, keep businesses basically from going bankrupt until you get a vaccine. And once you get a vaccine, the economy, this is going to be very U-shaped. The economy will bounce back with a lot of energy in 2021 once we've got a vaccine in place.
Remind me, David,
earnings will go up.
Remind me, David, we're now down about 30% or a little more off the highs of the Dow. What was the Dow's haircut during 2008-09? 50% plus.
I know the S&P 500 was down 53% peak to trough by March 9th.
You expect that kind of haircut this time?
No, I don't think we'll see quite that much because I think we've got scarier days ahead. But I think that the key thing is that this market is now cheap relative to long-term fair value. And people always ask me, was that the bottom? That's not the right question. We're not going to be able to time this. The right question for long-term investors is looking at bonds, looking at stocks, looking at cash right now. Does it make sense to be overweight equities relative to fixed income? It probably does. I know it's a scary time, but certainly, I think people need to recognize that if they haven't rebalanced, they are now underweight equities because their equities have taken a shellacking. And on a long-term, we will bounce back. We will get past this eventually. And there's a lot of value in these companies in the long run that markets are kind of discounting today.
John Bellows, what do you think? Clearly, the market seems to be pricing in a steep recession at the very least. What are the odds that this economy goes into a prolonged depression?
Well, one thing I've been struck by is just the speed and forcefulness of the policy response. It's just been incredibly quick. Think about this. Lehman Brothers failed in September of 2008. It took the Fed 3 months after that before they finally cut rates to zero. This time, the Fed cut rates to zero in less than 2 weeks in 2 intermeeting emergency cuts nonetheless. They're very, very forceful. On the bond purchases, they're purchasing over double the pace of previous QE programs, and there's essentially no limit to how many bonds the Fed can buy. So the Fed's response react here has just been incredibly quick.
But the market isn't
incredibly
buying
forceful.
it. The market isn't buying it, literally.
So clearly the reason the Fed's doing that is the economic emergency that we're facing is acute, it's severe, and it is largely unknowable how deep it is. I thought Jerome Powell was quite astute when he said we're not even going to write down forecasts right now. It's just unknowable. So yes, there is an unknowable nature to this. But look, I think that the Fed's response does matter, and I think once we do get some economic normalcy, some type of moderation, then it's going to be a really big deal. You have the Fed that's involved. They're involved in a serious way. You're getting fiscal policy in a serious way. And once you start to see demand normalize, and I tend to agree with the other speakers that you've had that eventually you will see demand normalize, the combination of normalizing demand and an incredibly forceful policy response is going to be a very different atmosphere than what people are used to. It's a very different atmosphere from where we are today, but it's also going to be a different atmosphere from where we are last year. Again, the combination of forceful policy and demand firming, is really going to create a different atmosphere.
The Dow is down
clearly
now, John, 2,000 points. I just interrupt to point that out, which is close to 10%. David, I want to listen to. I want to have us all listen to a comment from Mark Cuban earlier today on buybacks. Listen up.
No buybacks. Not now. Not a year from now. Not 20 years from now. Not ever. Because effectively, you're spending taxpayer money to buy back stock, and to me, that's just the wrong way to do that.
This is not no buybacks for all companies, David, but for companies that take federal money to stabilize themselves in the wake of this coronavirus setback. What do you think of that?
I think it's a silly comment, to be honest. I think that it's buybacks are another way of distributing income. I don't think companies should really be buying back stock in this environment. Are we going to say that they shouldn't pay out dividends also? I mean, I think that what we need to do is be logical and sensible and quick about doing what we need to do to help companies, particularly small businesses, medium-sized businesses, help workers. But I think this idea that we're going to put all sorts of restrictions on, what's good and virtuous and non-virtuous corporate behavior at this point is just a bad idea. It reminds me a lot of the punitive approach to banks in the middle of the financial crisis, which frankly made it worse. There's nothing wrong with buybacks. If you can't think of anything good to do with the money, give it back to the shareholders. You can give it back in dividends, you give it back in buybacks. It's really not a different thing. So, I think it's an easy target, an easy punching bag, but it's really not relevant to the problems that we face today.
Don't you think that a lot of the companies that engaged in buybacks wish they had some of that cash right now?
Yes, some of them do, but some of them don't. I mean, some companies have been doing buybacks as opposed to handing out dividends because it proved to be a more tax-efficient way of doing things. And frankly, companies have been very profitable for many years in the United States, and buybacks are simply one method of returning cash to shareholders. Theoretically, they're no different from dividends except for this. Buyback you can start and you can stop. A dividend, when you change your dividend, it sends a message to the markets. So companies, buybacks are, they're kind of like bonuses. You can raise them in the good times, but you cut them in the bad times. And I think companies are going to cut back on buybacks. I just don't think the government should be writing that into legislation.
Kelly?
Tyler, jump in and John quickly mentioned everybody again. The price action in Boeing today. The stock today is down 27%. It went below $90 a share, and it's currently right about those levels. Okay. John, obviously this is important, not just for that company, for the whole economy. It's critical to know what's going to happen here in terms of a backstop and what that's going to look like. I don't know, John, if you want to add a thought on that.
Well, I think that's certainly part of what they're considering. I think the problem's a little bit bigger than that one company. You're seeing a lot of stress in corporate bond markets more broadly. And, I think the Fed, one of the really important things over just yesterday is the Fed has already started being more involved in credit markets. Their commercial paper funding facility, the primary dealer funding facility, both allow them to be involved in corporate credit. And I think that's the direction we're going. I think we're going to see more of that. Whether that's a TALF-like facility where Treasury is taking a first loss position or some other arrangement that involves a coordination between fiscal authorities and monetary authorities, I do think that's where we're going. Another thing here, Kelly, you mentioned this earlier, was changing the Federal Reserve Act to allow the Fed to buy corporates. I do think there's stress in corporate bond markets. Again, I think this is bigger than Boeing. It's a broader market phenomenon, and I do think that if there's a need, the Fed will find a way to support those markets as well. Again, I'm just very struck by how forceful the Fed's response is, and I think we're liable to see more if we need it, rather than less of that going forward.
And as you're talking, John, there's the Dow below 19,000. So a shocking plunge right near session lows. John Bellows, David Kelly, we appreciate, again, a 10.6% drop in the Dow now, which was briefly halted earlier today once the S&P hit limit down of 7%. But the selling pressure continues apace as we move throughout the session today.
A breathtaking slide in stocks. No more so than in hotels. They are getting crushed yet again today as the coronavirus puts the travel industry basically at a standstill. Seema Modi now with the drastic steps they are taking. Hi, Seema.
Yeah, Tyler, incredible moves today. The hotel operators making the tough decision to shut down a number of properties as it doesn't make economic sense to keep them open when occupancy levels are plunging across the U.S. In some cases in the single digits. That's what Hilton CEO Chris Nassetta told President Trump he's seeing yesterday, and that's forced Hilton to temporarily close Hilton Midtown and the Capitol in Washington, D.C., but among other hotels. Both of those are not accepting reservations for the foreseeable future. And it follows news from Marriott, furloughing tens of thousands of employees as it actively looks to suspend operations at certain locations. Today, Pebblebrook, a hotel real estate investment trust that manages 54 hotels, announcing that it's letting go of 4,000 employees. It expects to let go of an additional 2,000 if the situation gets worse. The hotel industry now requesting a $150 billion package to cover the 3.9 million workers supported by the hotel industry that will lose their job if occupancy remains where it's at right now. That's according to AHLA, the trade body that represents the hospitality industry. Guys, another data point being circulated today, $1.4 billion in revenue is lost every week due to the virus for these hotels. You can see they're sitting on double-digit losses over the last 3 months. Back to you.
And look at that. Look at Marriott down 67%, Hilton down 53%, and Hyatt down also more than that. What is, maybe you said it, I was distracted there for a minute. What is the occupancy rate right now?
So occupancy rate dropped 24% in the week ending March 14th. So it comes out to around 54%. The average for the month of March is typically around 64%. But clearly they're expecting more pain to come as all of these major hotel operators review the status of their hotels across the nation, view the occupancy levels, whether try to make that decision about whether they
unemployment offices simply weren't ready. In New Jersey, Governor Phil Murphy says it is seeing a record number of unemployment applications. The state receiving 15,000 claims on the 16th alone, a wave that crashed its system. Labor officials in New York say that they're seeing unprecedented volume, and at times more than 10 times that of last week. The state is extending hours to try to manage this increase in applications. So I spoke to a New York City bar owner yesterday who told me not only did he have to lay off his 25 employees, he's now trying to figure out how does he pay his rent. It's one of many questions that small business owners and employees are facing indefinitely. According to data collected by outplacement firm Challenger Gray and Christmas, the closure of restaurants and bars could impact more than 9 million workers nationwide. The firm saying layoffs for some 3,600 workers have been announced so far. with the majority being in the entertainment and leisure industry. Andy Challenger, however, also cautioning me earlier that that number, that 3,600 number, saying that's likely just the tip of the iceberg. I'll send it back to you guys.
I wonder about the capacity challenge, Rahel, and where all this, you know, in 0809, as deep as it was much more drawn out than it is now. So I think it's important for people to know that these benefits are available, to go get them. I guess there's federal backup to make sure they can keep accessing the funds. But, you know, are they going to face just issues trying to show up in person or even use these services online in order to get those benefits?
Well, Kelly, I'm already hearing anecdotally from people who say that they're trying to access these services, right? They're trying to get onto the New Jersey State Labor Department's website, and they can't even apply because, as I mentioned, at points the system was shut down. So, of course, those services are available, and the officials that I'm talking to sort of stressing that point that they are doing everything they can to make sure that they address these needs. But there is that issue of just actually applying first things first.
Okay. Rahel, we appreciate it. Rahel Solomon, she'll keep track of that for us. The big three automakers, and this is related, closing all U.S. auto plants as the coronavirus spreads to all 50 states. Let's go back to Phil LeBeau for more on the details here. Phil?
And Kelly, when we first reported this about an hour ago, there were a number of people who said, well, why didn't they announce this last night after the UAW and Big Three CEOs got together? Remember, initially it was a partial shutdown. Well, now it's a complete shutdown. And perhaps it's because they realize that as this virus continues to spread, it makes more sense just to shut down production altogether. So what you're looking at is the Big Three shutting down their plants effectively after the second shift tomorrow night, usually about 10:30, 11 o'clock. And then they're going to be down, for the most part, all the way through March 30th, March 31st. 25 final assembly plants here in the United States, and this impacts about 150,000 UAW workers. And oh, by the way, it's not just the Big Three that are stopping production. Earlier today, Honda came out and said that it will be shutting down its production in North America. That impacts its 4 plants, its 4 facilities here in North America. And then there's the case of Tesla. Now, this is really interesting. Tesla's Fremont, California plant is in one of the counties where they basically have not put a sheltered in place, but they've basically made it so that if you're not an essential business, people shouldn't be going there. Well, people were showing up at work today, so it appears that the plant is still open. By the way, we've reached out for Tesla for an official comment here. As you take a look at shares of Tesla, like everybody, just getting hammered in this market. It'll be interesting to see if they make an official call here in terms of whether or not production has stopped at that plant. Kelly?
Okay, Phil.
And Phil, Delta announcing a $2 billion decline in March revenue, and they're going to cut capacity by 70% as airlines deal with this unprecedented crisis. Will airlines get a bailout? Phil, what do you say?
Well, the latest reporting from NBC is that there's 3 parts of the bailout that the White House has put forward, including $50 billion for the airline industry. So it appears that this is part of one of the packages that will ultimately be approved, though we have not gotten official exclamation point on that, yeah, okay, $50 billion has been set aside for commercial airlines. Remember, the industry was also asking for $8 billion for the cargo operators. The airports, I don't even know where they're at in this entire thing. They're asking for $10 billion. They might be part of another aid package. And when you look at the individual airlines, a couple others, I know you mentioned Delta. Take a look also at JetBlue, dropping an 8K today in which they say they have drawn down on their $1 billion term loan. They took out that term loan last Friday. They had drawn it down by Monday, an indication of how quickly the airlines are moving through their cash and trying to shore up their liquidity. Also, United announcing last night that it's increasing its April schedule cuts, going all the way up to 60%. And remember, it was just, what, 50%? Just, a few days ago. So we're seeing this with all the carriers. As more people cancel flights, they're bringing down their schedules even further.
All right, Phil, thank you very much. Phil LeBeau in Chicago.
Now let's get to Sue Herrera for the very latest on the coronavirus. Sue?
Thank you very much, Kelly. Here's what's happening at this hour, everyone. Italy has posted its biggest daily death toll from the virus. 475 people have died since yesterday's report, bringing Italy's total to just under 3,000 dead. At this pace, tomorrow, Italy will overtake China for the highest death toll. Global deaths now number just over 8,700. Worldwide confirmed cases are above 212,000. The World Health Organization chief is renewing his calls to test and trace as many cases as possible. He says those efforts must be the backbone of the world's response to the coronavirus pandemic. Switzerland is rationing common painkillers and anti-fever drugs to prevent panic buying. Officials stress the move is not being made because there are shortages right now. The restrictions will last for 6 months. And here at home, homeowners with mortgages backed by Fannie Mae or Freddie Mac will not face foreclosure or eviction for about 60 days. Federal regulators have made the move to help those struggling with bills because of the coronavirus. Story that our Diana Olick has been following. You are up to date, guys. Kelly, I'll send it back to you.
Okay, Sue, thanks very much. And since it's about half past the hour, oil has just closed up for the day. And I'd say investors are relieved, but we know it keeps trading in the after-hours market. And there you can see the decline of 25%, one of the worst days ever for crude. In fact, the third worst session we've ever seen for WTI. Just over $20 a barrel right now. That's more than a $6 plunge to its lowest level since February 2002. WTI has been slammed this year by multiple factors. You've got the coronavirus taking its toll on global demand. Exporters and producers are ramping up production, as we've discussed with Brian about Saudi Arabia tied. Just nowhere to hide and a really rough session. That's one of the things going on in this market.
Yeah, and there's the Dow plunging 2,200 points or more than 10%, almost 11. As oil tanks, we are at session lows on equities. And let's go back to Bob Pisani at the New York Stock Exchange. A significant slide here in the last half hour, Bob.
Yeah, and what Kelly was talking about, oil, a part of the component of the generalized anxiety. So when traders see stocks down, bonds down, oil down, gold down all in a row, they think, that's not normal. That means people are raising cash. And that, of course, raises concerns overall here. So here's where we were about 12:30. Bill Ackman started talking. He said, essentially, we need a 30-day spring break that you have to get very aggressive, close the whole country down, including the GM facilities, obviously. And the market started sliding on that. We did hit the circuit breakers a little earlier in the day. Let's just review those circuit breakers. Once again, 7%. That already happened, so that's gone. We now have to stop at 13%. We're down 10 to 11% right now. That would halt trading for another 15 minutes until 3:25 p.m. Eastern Time. Then no trading halt unless you drop 20%, and then it would halt it for the rest of the day. Dow movers, it really is very much about a few stocks. Boeing is the main one here. Hard to believe here, but Boeing is about 220 points in the Dow for the downside. Broke over under $100 earlier today. Chevron as well, Amex, Walmart, and Walgreens are the only two stocks that are moving on the upside. But Nike's down 12%, for example, and Home Depot is down about 12% or so. And the overall concern here is not just cyclicals anymore, but the consumer and whether these companies are going to be able to see a significant amount of buying, essentially when many of them are closed. So still a fairly broad decline, except for a few food companies and grocery stores today. Guys, back to you.
All right, Bob, good to see you. Thank you very much, Bob Pisani. And still ahead, Bill Ackman had some tough talk for President Trump. Our own Scott Wapner talked with the famed investor, and he'll join us with why Ackman is so very worried about the current environment and our response to it. And Domino's lower by about 4% today. Domino's CEO Rich Allison will tell us how his restaurants are handling the coronavirus and social distancing. That is coming up when we return.
Consistency can deliver on investment goals. Columbia Threadneedle Investments.
One of the products I helped develop at 3M was a more secure diaper closure. There were babies involved, and they weren't saying much. That's what we do at 3M. We listen to people, even those who don't have a voice. We are people helping people.
There's the master bedroom. Office.
A workout room. Get my treadmill. Add some weights.
It's a nursery.
Nursery?
At Amica, we believe in life's extraordinary experiences, so much so that we built a company around it. With every phone call, every quote, every claim, we're an insurance company that delivers an experience that meets the only standards higher than ours. Yours. Experience Amica. Auto, home, and life insurance.
Legacies don't just happen. They're built with relentless determination and a compulsion to exceed expectations that knows no bounds. And then you keep going.
people did underestimate the coming outbreak. And I've got to tell you that as far as I'm concerned, it really isn't one of these situations where we can just kind of ride it out. We have to think about it. We got to figure out what to do. We got to work together.
Watch or listen live on the CNBC app.
Hey, did you?
Yep, done.
And the...
Of course.
And...
Oh, yeah.
All in one...
Hour.
Behind the world's most productive people is the world's most comfortable chair, the incredible X Chair, featuring patented dynamic variable lumbar support. X Chair's adjustable seat depth keeps users small to tall, comfortable and supported. Available in breathable mesh, HDR foam, or top grain leather. Customize comfortable positions for your neck and arms. And X Chair's patented SiFloat Infinite Recline provides the perfect recline for users of almost any size. X Chair leverages 21st century technology to create the most comfortable, productive workspaces in the world. This is not your grandfather's office chair. Call or click to get $100 off the amazing X Chair, featuring dynamic variable lumbar support. Plus, for a limited time, you can also add X-Wheel blade casters as a free upgrade and free same-day shipping. Just use code TVWheels. This deal is good for any X Chair you choose. Call or click to order today and receive a 30-day risk-free trial and $100 off.
Well, let's take a look at where the markets stand right now. If you dare, you probably want to send the children to another room as we look at the industrials off more than 10% at 19,065. We were below 19,000 for a few moments, just a few moments ago. The S&P 500 down about 9%. As you recall, there was a 15-minute pause. If we go down 13%, I believe that's the number, there will be another pause unless we are in that last sort of 45, 40 minutes of the trading day. The NASDAQ at 67.49, down almost 8%, comparatively doing better. The Russell comparatively doing worse. It is down 11.5%, below 1,000. It is at 979 for the first time in years. Kelly?
Yeah, more than a 40% drop from the highs. Okay, in today's one of today's big interviews, our own Scott Wapner spoke with Pershing Square's Bill Ackman about his warning for President Trump and Wall Street if the president doesn't shut down the country for 30 days to deal with the coronavirus outbreak. Listen.
Until a vaccine is manufactured, distributed, and injected, we will go through a depression era period in the country. Take a look at Hilton stock. It's going to zero, okay, along with every other hotel company, because every hotel is going to be shut down. The only answer for the world is to shut the world for 30 days. The hotel industry and the restaurant industry will go bankrupt first. Boeing is, on the brink, okay? Boeing will not survive without a government bailout. We have to shut the borders, okay? And then 30 days later, the virus is gone in America, largely gone in America. And then we have to be careful, okay, for the next 12 to 18 months until we have a vaccine. The other way we save lives is by saving the economy. The U.S. Treasury does not have enough money to bail out every company. You can't borrow your way out of the problem. You can't lend your way out of the war. You got to kill the virus. The closest I had was the financial crisis, where I'm saying, things are coming, bad stuff's coming. But this was a feeling like I've never had, like there's a tsunami coming. Corporate America is in shutdown right now, okay? It just doesn't know it yet.
I mean, it was scary enough the first time without the black and white and the music, Scott. I mean, people said that's why the stock market was halted, because people were terrified after they heard that interview. He said hell is coming, and he's buying stocks.
And that's why, I'm going to be honest with you, Kelly, at certain points during the interview, I felt like I wanted to go to the ledge. And then on other parts of it, I felt strangely uplifted in the same feeling. Maybe others had the same feeling, too. I don't know. He's very worried, obviously. He talked about withdrawing large sums of money from the bank. So he never walks around with more than $200 in his wallet, he said, but he was going to the bank and getting out a lot of money because of what he said had to be done. And the sense of urgency and fright in his voice was apparent, obviously, to everybody trying to get his message across. And then yet being able to somehow step back and say that he was buying Hilton, which he's already a huge shareholder in, even thinking that things were going to get so bad. He was buying Starbucks on the way down. He's got a high concentration in consumer-led brands, whether it's restaurant brands, Chipotle, and names that we all know that he's been invested in. And here we are saying that he thinks that, I guess, we're going to come out on the other side okay.
and that he was willing to take that bet and buy stocks. But the warning was dire. It was sobering. It was tough. It was tough.
You know, let's talk for a second, Scott, about what he said in his investments, because, you know, it's not going to be the part of this that everyone talks about, but it is important context. So he talked about, look, Hilton could go bankrupt, but he owns Hilton, right? I mean, he owns Chipotle, he owns Starbucks. You know, there are names here that, and you tell me, what was his sort of thought process about the market in general and about these names and the price action there?
I think you have to put they're going to go bankrupt, and there's going to be these rolling bankruptcies, you know, by industry to industry, as he sort of went through and named the ones he thought were going to happen first. If is the critical word we need to put here. If the government, if the Trump administration, if the president himself, who frankly Bill Ackman was appealing directly to, don't all listen to his warning that as much as we've done to this point, that it's just not enough, and that certain people in certain age groups are not listening to the warnings that Dr. Birx mentioned today. Millennials, people who are younger than those who are deemed to be more at risk. They've heard the initial warnings of this overwhelmingly affects the elderly worse. So people were assuming that they weren't going to be having a problem. Beaches were packed down in Florida over the last several days. We all saw those pictures. Boardwalks of some people walking hand in hand and close together in other parts of the country. And I think it's a call to arms, if you will. I mean, he described it as a wartime.
Yeah, and you're right. Yeah, Scott, you're absolutely right. His audience, I think it's fair to say, is not so much our viewers, it's the president, don't you think?
I do, but I think it's everybody.
Right.
To try and, you know, the president is the one who needs to act as he wants. The investment community is to spread the word. This is real. Whether you believe it is as bad or could get as bad as Bill Ackman says, that's your own point of view, and you're certainly entitled to it. But he leaves us with the thought that Bill Miller told you, that this is an incredible buying opportunity, one that we'll hopefully get to look back on someday, Kelly, and realize that and witness that, because the government, the administration, the president did what he thinks is necessary. And to use his words, it's to shut it down now.
All right, Scott, thanks. We appreciate it very much. Scott Wapner.
All right, we're going to move on now and hear from the CEO of Stifel, Mr. Krzyzewski, and banks, of course, being very much among the worst performers, battered. Citi down about 19%, Capital One down 21%, Synchrony Financial down about 25%. And that's just today. For the latest moves on the bank market volatility, let's bring in Ron Krzyzewski. He's the chairman and CEO of Stifel Financial. Mr. Krzyzewski, thank you for joining us. How bad is it?
Well, so, I mean, look at your screen. In terms of the uncertainty, I find Mr. Ackman's interview on one hand doomsday, and on the other hand buying stocks. I found that, you know, I guess interesting. Here's what I want to say. You're showing pictures of people holding hands. I'm speaking here from the Midwest. The American people understand. The American people are doing fist bumps or elbow bumps, sanitizing, social distancing. Let's not lose sight of the fact that a lot of the things that need to be done to combat this are in fact being done, and being done significantly. And so there is, you know, what is the objective of this? It is to flatten the curve, and I believe that is being done. Now, I'm not a doctor. Do we need to lock everyone up for 30 days? Maybe. That's for decisions above my pay grade. But I don't think the American people aren't reacting and doing what they always do, which is to band together and fix the problem. The American people will fix this.
I sense you're right. I mean, we, of course, live in the New York area where there is a real multiplication of the number of cases. New Yorkers are prone to, well, let's just say, not take things necessarily in the calmest way. Midwesterners may be a little more prone to be calm about this. Are you sensing a real fall-off in commerce where you are, traffic where you are, changing of habits where you are?
Absolutely. I mean, they're closing restaurants at midnight on Thursday. They've done it in Illinois. There is a real effort to limit social interaction so that we can flatten the curve, which seems to be the objective. What I think about when I look at the market, there needs to be liquidity. I think the Fed and the Treasury are doing all they can to ensure that the markets stay liquid. We need information, which is more testing so that we understand what's going on.
Right.
But the most important thing from a market perspective, I will tell you, give the market bad news, it will deal with it. Give the market uncertainty, and you will get a VIX at 85. And this kind of uncertainty, the market does not like uncertainty.
No, this is the ultimate uncertainty. Wouldn't you agree? I mean, because we do not know. We do not know when it ends. We do not know how it comes back.
Well, I think what the people have to be thinking, at least, is that we need to take a period of time, and this probably needs to be articulated, but we need to take a period of time where we are going to shut down the economy to battle the spread of this disease. We also need to say that there's going to be a point in time when the curve flattens that we're not going to shut down the economy, because everyone knows that you can't shut down the economy for a year.
Yeah.
The cure will be worse than the disease.
Let me just ask you one thing. I keep hearing, I think intended to be reassuring, that the banks have never been healthier than they are today. They're in great shape. They've got capital like they didn't have in 2008. That's all good. If they're so healthy, why are they performing so badly?
Well, I think that if you say that every company is going to go bankrupt, and all the hotels and airlines, and that the banks are not going to, capital can be dissipated pretty quickly in a doomsday scenario. It's not like the economy melts down and the banks are standing. So I think all sectors are facing this. Again, what appears to be, and I think it's television, I think it's a lot of things here, people need to use common sense. Where I live, people are practicing what they're being told to do. They're not going out. They're not going to restaurants. They are limiting their social interactions. That will have an impact on the curve of this disease. And when we start, and I think it'll be relatively soon, we will begin to see that we flatten the curve. And you know, I don't believe the world's coming to an end. And if it does, no one will watch this interview anyway. So I just think that calm and common sense and the government. Here's the one thing that I'm upset about as an investor. We need the fiscal stimulus. I don't care what the heck the plan is at some point, okay? Get one announced, whether it's $1,000, $2,000, bailouts, whatever. The market needs some certainty and some action. Otherwise, you're going to see the volatility continue to explode. Let's get something done, and that's a message. That's a message to Washington.
Yeah.
Why we don't have a fiscal deal done because there's some, political partisanship is ridiculous. This needs to be announced today.
And Ron,
that'd be my message.
To illustrate what you're discussing, J.P. Morgan's out with a new, I don't know if I should call it a forecast and estimate for GDP for the year. Bottom line is this: I think 4% contraction first quarter, which we're in right now, 14% contraction in the second quarter, maybe then a rebound back half of the year from that very steep contraction. So do you think anything can be done right now to keep it from being that bad, including what you're saying, announce the number, get the checks to households, however that money can be distributed, go for it?
Well, look, I don't think there's anything that can be done to stop the contraction that's going to occur, primarily in the second quarter. There'll be some, obviously, in the first, but I don't think there's anything that can be done. The question is can this end so that the economy can begin to rebound? I mean, the market has, whatever the economic is for the next 3 months, the market has taken far more out of market values than what that would be left in a vacuum. So, I'm less concerned about whether there's going to be a recession. I'm assuming there will be one. I believe that we need certainty, and I think the message should be, and at least here from the Midwest, I'm telling you that people are doing what they're supposed to be doing and being told to do. And I believe that we will look back and say, yes, this was the right response to flatten the curve.
I think they're mostly doing that here in New
calm.
York as well. Let me just close with one question, if I might. I want to go back to Bill Ackman, whose comments impassioned, as you heard. Do you think he's right? Do you think he's too alarmist? Do you think he's ridiculous? How would you characterize those? If you were sitting here talking to him right now, what would you say to him?
Well, I think that, he's making the comment we need drastic action, and I think he put it in a 30-day vacation for everyone.
He did.
Where I'm not sure that I agreed was that I don't believe that if everyone went home for 30 days, I think it would flatten the curve, but I don't think we eradicate the disease because in 30 days we can all open our doors, walk out, and go back to everything. I think this is going to be a continual development. So I don't believe that in 30 days the world would, the disease would be gone around the world if everyone did that. That's my own opinion.
Right.
Again, I'm not a doctor, so I don't want to argue too much with Mr. Ackman. But I do believe that we are doing actions which are going to cause this to be handled. I do believe that stocks will be higher, significantly higher a year from now, but we'll see.
We'll leave it there. You may not be Coach K, but you are CEO K. Mr. Krzyzewski, thank you very much. We appreciate it. And be sure to stay with CNBC as we'll hear from the former Citigroup chairman and CEO, a legendary figure on Wall Street and in the American economy, Sandy Weil. He will join us today in the 3 p.m. hour to discuss the banks and the market volatility. He's seen a lot. You don't want to miss it. Kelly.
All right, Tyler, restaurants are getting hammered again today as more shutter or turn to just takeout in order to help stop the spread of coronavirus. Kate Rogers has the latest on this state of play. Kate, a lot of deep red on that screen today.
Hi, Kelly. That's right. The restaurant industry has been rattled as now 20 states have limited service to takeout or delivery. Data from Black Box Intelligence show that nearly 70% of restaurants have experienced a drop in traffic through March 13th. Today, the National Restaurant Association projected the industry could lose some $225 billion in sales over the next 3 months, which will prompt the loss of between 5 and 7 million jobs. But some companies are now able to lean heavily on their delivery systems as the virus continues to spread. Domino's, for example, has instituted a contactless option with custom drop-off points for customers. And the company's CEO, Rich Allison, joins us now by phone. Rich, thank you for being here.
Thank you, Kate.
So we understand that you, along with other restaurant CEOs, had the chance to speak to President Trump yesterday. I'm curious if you can tell us a bit more about that call and give us your reaction to the federal government's response to this crisis.
Sure, Kate. Well, we did have an opportunity yesterday to have a brief but productive discussion with the President and Secretary Mnuchin, and took the opportunity as an industry to stress the important role that restaurants play in serving our communities, not only in feeding people, but also in employing folks as well. And the President and the Secretary showed a good bit of support for the industry and an appreciation for the role that we play.
You've employed tactics, that I mentioned, like contactless points for customers. Are you seeing more people turn to you during the pandemic?
Kate, for us, we're historically, here in the U.S., 55% of our transactions are delivery already. And what we've done here as we've gone through this, started this crisis here in the U.S., we've really leaned heavily on the learnings that we've had out of China and Japan and South Korea, countries that have been really on the forefront of this epidemic. And our partners over there have just done a terrific job developing procedures around contactless delivery so that we can continue to safely serve our customers while respecting that social distancing that is so important in helping our societies all over the world mitigate the expansion of this disease.
So, Rich, if closures are forced at stores, does the company have a plan to support both employees and franchisees?
So we've had no closures here in the U.S., 1, 2, maybe. We have had some closures across several of our international markets. And, our first priority is going to be, in the event of any closures, to look out first and foremost, for our team members. And we've implemented already here in the U.S. some emergency sick pay in place for our team members. Also pay for our team members were they to be on a 14-day quarantine. So we're going to put our team members first and foremost, alongside obviously the safety and well-being of our customers, Kate, when we make decisions about when a store would need to be closed and how we would treat those that work in that store.
And Rich, if I could jump in for 1 second, it's Kelly here. How much is business down, would you say? Because again, I would imagine Domino's is one of the companies that could get through this as long as people can continue to order from all your restaurants. But how much are we down now? What's your worst case projection, and do you have the cash to get through it?
So, Kelly, we're continuing to serve our customers, through both the delivery channel that I mentioned earlier, but also the other big piece of our business, which is carryout. Now, we've rolled up all the tables and chairs inside our stores, so nobody's sitting in the stores today, but we do have procedures in place to safely serve our customers carryout, either at the counter, at pickup windows in some of our stores, or at the curb. So because we don't have a significant sit-down table service business, we've been able to continue to serve our customers as they need us. And, to the second part of your question, we enter into this period of time very healthy as a company, very healthy balance sheet, and also, most importantly, our franchisees enter into this period, with very strong